You invest 10,000 rupees in a mutual fund. A few months later, you check your account and see that it's worth 10,500 rupees. That's great news. But have you ever wondered where that extra 500 rupees came from? What actually happened to your money after you clicked the invest button? Did it go into stocks? Who decided where to invest it? And how can thousands of people invest in the same mutual fund at the same time? Most people invest in mutual funds, but very few understand what happens behind the scenes. The money doesn't just sit in an account waiting to grow. In this video, we'll follow your money step by step and uncover how mutual funds really work. By the end, you'll know exactly where your money goes and how returns are generated. Imagine you want to start investing with 10,000 rupees. You could buy shares of one or two companies. But that's where a problem appears. If most of your money is invested in just one company and that company performs badly, your investment could be affected significantly. With a small amount of money, it's difficult to spread your investment across many companies and sectors. That means your risk remains relatively high. Think of it like carrying all your valuables in one bag. If something happens to that bag, everything is affected. This challenge isn't unique to you. Millions of investors face the same problem. So how can small investors get access to a large, diversified portfolio without needing lakhs of rupees? The answer is surprisingly simple. Now imagine that instead of one person investing 10,000 rupees, thousands of people invest together. One person contributes 10,000 rupees. Another contributes 5,000 rupees. Someone else invests 50,000 rupees. When all this money is combined, it creates a very large investment pool. Instead of investing with just 10,000 rupees, the fund now has a much larger amount to work with. This allows the money to be spread across many companies and investments. And every investor owns a small share of that pool based on how much they invested. This simple idea is what gives mutual funds their name. Many investors come together and invest collectively. But once all this money is pooled together, who decides where it should be invested? Now that thousands of investors have pooled their money together, someone needs to decide where that money should be invested. That's where the fund manager comes in. A fund manager is a professional whose job is to manage the mutual fund's investments. They study companies, analyze financial reports, track market trends, and look for investment opportunities. Based on the fund's objective, they decide which stocks, bonds, or other assets to buy and sell. But they don't simply guess. Their decisions are supported by research teams, data, and detailed analysis. In a way, the fund manager acts like the captain of a ship, helping guide the fund toward its destination. But once these decisions are made, where does the money actually get invested? Once the fund manager decides where to invest, the pooled money is put to work. Instead of buying just one company, the fund usually invests in many different assets. Some money may go into stocks, while some may be invested in bonds. This creates a portfolio made up of many investments. When you invest in a mutual fund, you don't buy these investments directly. The mutual fund buys them on behalf of all investors. This allows even a small investment to gain exposure to many companies at the same time. In simple terms, your money becomes part of a much larger investment portfolio. But why spread money across so many investments instead of choosing just one? That's where diversification becomes important. Imagine putting all your money into a single company. If that company does well, your investment grows. But if it performs poorly, your investment could suffer significantly. Mutual funds reduce this risk through diversification. Instead of investing in just one company, the fund spreads money across many different investments. Some may be banks, some technology companies, and some consumer businesses. This means the fund is not dependent on the success of a single company. If one investment performs poorly, others may help balance the impact. Diversification cannot remove risk completely, but it can reduce it. That's one reason mutual funds are popular with investors. But if you don't directly own the stocks, what exactly do you own? When you invest in a mutual fund, you don't directly receive shares of the companies in the portfolio. Instead, you receive units of the mutual fund. The value of each unit is called the net asset value, or NAV. Think of NAV as the price of one unit of the fund. As the investments inside the mutual fund increase in value, the NAV usually rises. And if those investments lose value, the NAV can fall. For example, if you invest 10,000 rupees and the NAV increases over time, the value of your investment also grows. So when people say a mutual fund has performed well, what they're really seeing is an increase in its NAV. But what actually causes the NAV to rise in the first place? That's where mutual fund returns come from. Now let's come back to the original question. Where does the profit in a mutual fund actually come from? The answer is simple. The mutual fund's investments need to grow in value. For example, if the fund owns shares of companies and those companies perform well, their share prices may rise. Some investments may also earn interest or generate income. As the value of the fund's investments increases, the overall value of the portfolio grows. And when the portfolio grows, the NAV of the mutual fund usually increases as well. That's why the value of your investment can rise over time. In simple terms, your returns come from the performance of the investments owned by the fund. But if returns can go up, can they also go down? Mutual funds can reduce risk, but they cannot remove it completely. That's because the value of a mutual fund depends on the investments it holds. If stock prices fall or markets go through a difficult period, those investments may lose value. When that happens, the NAV of the mutual fund can fall as well. This is why mutual fund returns don't always move upward. Some days, months, or even years can be negative. A mutual fund reflects what is happening in the market around it. But that's a normal part of investing. The goal is not to avoid every market decline, but to participate in long-term growth. So if returns can rise and fall, what exactly makes mutual funds such a popular investment option? A mutual fund allows many investors to invest together. Instead of investing alone, thousands of people pool their money into a single fund. That money is managed by professionals and invested across many different assets. In return, investors receive units of the fund. As the investments grow in value, the NAV can rise and your investment may grow as well. And when markets fall, the NAV can decline too. This means mutual funds offer both opportunities and risks. In simple terms, you own a small share of a much larger investment portfolio. That's what makes mutual funds a popular way to invest. But not all mutual funds are the same. So how do you choose the right one? There's always more to discover. Like, share, and subscribe to Beyond Basics for more fascinating videos made simple.